Right, it is 6:25 p.m. Eastern Time on Sunday, the 16th of August. Welcome, belatedly, to another Unmissable Sunday show. Hi, Benny.
Hey, buddy, how we doing?
Good. Listen, we've got to talk about sort of volatility at length. It's in the doldrums right now. I then want to talk about Hong Kong real estate. And then I'm afraid we do have to talk about your former colleague, Gavin, because that all-in podcast, that was something else. That was something else. I'm still in shock. I even tried to watch it this week. I usually employ a stunt double. Thank you, Jason, to watch it and take notes on behalf. And I just saw too many clips that I thought I would try and watch it myself. I made it to minute 15.
Yeah, I can't watch that show. But they do like to repeat it over and like, oh, this and look, as I told you, Gavin's a former colleague of mine, smart guy. These guys have a lot of wood that is unrealized, so it's only in their interest to be promoting. Just understand, and just to be fair, everyone, if you had generational wealth on the line, is incentivized to be promotional. They might be right and they look great. They might be wrong and they don't, but they're definitely biased. Let's put it that way.
What I would say is your basis ain't their basis. So act accordingly.
Yeah. So let's get into it. It's funny that the summer was exciting. We started off, we had the SpaceX IPO, then we had the Google surprise. 80 some $billion equity raise, Nvidia raised debt, and Amazon raised debt. So there was a bunch of capital supply. And then it crescendoed when, the young buck was situationally unaware and he got himself running, 4 times notional leverage with 100 vol stocks. We all know that ends one way. You're not in the private equity market, buddy, right?
It wasn't just the 24-year-old. Look at Jane Street's numbers, for God's sakes, right? They were untouchable until a 15-yard write down.
To be fair, they're still up like 35, 40 billion for the year, so they're doing okay.
Yeah, small violins.
So yeah, let's talk about volatility. I decided, I was like, all right, you know what? This actually feels like summer, so we're titling the show, sleepy summer days and volatility. We got the squirrel taking a nice nap in the hammock, even though it's ironic that it's the winter for the squirrel down there in Melbourne right now. But he's living
7 degrees, buddy. It's cold. It's 7 degrees. It's cold. It couldn't feel less like summer if it tried.
But this is the realized 5 and 10 day vol, which is what unfortunately our markets these days run off of. We're near the lows for the year. It was a spike up until that Fed week into the BOJ. Warsh kind of bent the knee, dollar rolls off. BOJ comes in and takes some pressure off that. And then since then, we've had a bull selling bonanza, basically. Let's go through a couple slides.
Yeah, let's do that. We're returning to our favorite NASDAQ versus S&P vol and the put skew. Just remind everyone, we're going to come back with this chart very, very regularly. It's a really, really key indicator, but take everyone through, particularly the last red circle.
It is actually really important because it's like when you get these when you're in the middle, it's whatever. It's not that important. It's about everything in macro. It's about the jaws. When you get divergences, that's when you want to pay attention. And you looked at, and we talked about this in early June when we were kind of like, well, this might be the top. Look at that NASDAQ vol divided by S&P vol. It was at a really low level relative to the last couple of years. And then, not surprisingly, NASDAQ divided by S&P, which is the black line, skyrocketed. And now it's like the DRAM guys start with 250K, and then they got 25 billion. And we got the 24-year-old with apparently he had 45 billion assets under his control at the peak of his powers. Then that comes in, we diverge. The kid gets married. He gets fun taken to him by a longtime Wall Street vet named Ken Griffin. Welcome to Wall Street, and that kid will be fine, and he's a billionaire. But so we've converged some, and so let's keep going on this.
Yeah, I mean, I had a drink with the Dredge, with the judge last Thursday, and hat tip to him. The red circles are Dredge's world. He's a red circle guy too. But let's kick on.
You know, so the one feature we've had since we've kind of started this podcast, more or less, is that we've had this single stock to, you know, index vol rise, right? So we started this and call it the Q4 of 25. And, you know, it's moved around, but it's been up and to the right since the end of 24 with a couple oscillations. You know, the black line is the equal weight VIX, right? So we're, you know, look, it's not perfect, but like, yeah, this is good for me to like pull up. It's been 28% drawdown in equal weight VIX, which if you look at since around the time that we started this, you know, in that Q3 25, it was pretty much up and the right, Rupert?
Yeah, absolutely. And you know, what's interesting, you'd have thought that would have created a bit more pain in the dispersion complex, right? Just the recent well, actually, to be honest, the whole dispersion trade's gone remarkably quiet, but it's absolutely the dominant factor in markets right now still.
Yeah, well, let's say it did cause a panic, right? Like, again, you said Street, which is arguably the best hedge fund in the world right now, lost $15 billion in a month. This wonder kid had his fund taken away from him. He lost $30 billion. I don't know the exact number, but he lost an enormous amount of money. Like, there were some guys who got cleansed. You know, the 3%, 4% of the Korean population got margin called. Like, that there was some damage there, right? Like, it wasn't index level, you know, correlation goes to 1, which I know that's what you're saying, but there was some actual damage that just happened. And once, you know, the one thing I would tell you is when positions get cleared out and Rupert calls you and says, hey, we're doing the cleanup trade. I remember doing the cleanup trade on AIG. That was a good one. They were selling us stock that was 2 points below where it was traded in the market through brokers. So, you know, cleanup trades tend to be good entry points. And I think that's kind of what's happened here. And now we got through the Meg 7 earnings. We got, you know, we have a couple of retailer earnings, whatever, as we talked about in the last Thursday show with our boy, Mr. Retail, Jeff Mackey. So, you know, maybe that's something. But I don't think the consumer is moving the needle right now at all on a macro level. I think that's more of a stock by stock. So we've had a pretty good, like, drawdown. And that's a unique difference than what we've seen, you know, so far.
I have to say, you know, hats off to Jeff. I mean, you know, consumer retail, tough sector, no one talking about it, and he's putting in some extraordinary returns just with good old-fashioned stock picking. I love it. Absolutely love it.
Absolutely. And that is a good thing for people to remember. And there was somebody who commented on our thing last year, was like, you love to see a guy who's like talking about things that you're not talking about at all, which was one of the reasons why we brought him on. You know, it was before retail earnings, but it's also like there's no one talking about consumer stocks, like zero. You know what I mean? Like that. And so in this world of AI and LLMs and semiconductors and the Fed and Trump and Korea, like, you know, retail's all but forgotten. You know, even the big dogs, no one talks about basically.
Okay. Well, listen. Let's stay with the vol theme because this is another way of looking at the same chart that we were looking at.
Yeah.
And you know, this is the thing that surprised me because I thought that collapse in single stock vol. Yes, we saw a couple of bodies floating to the surface, but it did not create the correlation 1 event. You know, the index levels being, you know, look at that. It's all-time highs still. It's pushing on. It's looking remarkably robust, in fact.
Yeah, because I think what the thing is that the right tail stuff was driving returns. And so it was basically like when that unwound, the people running that trade got absolutely smoked, more or less. Right. And so it's a difficult market if you're using the old model of everything's correlated and it's one market. But under the surface, as we've talked about a lot, like very different. I mean, even to Jeff's point, like within retail, you can make money long and short, and there's dispersion. It is very much a dispersed market, and that was a good example of like the money was being made in a way that I don't think the average market participant understood. And then when that comes in, you got some of the people who are winning get cleaned out, but it actually makes the situation a little better. The leverage got burned off in some sense.
Okay, why don't you run us quickly through the rest of the rest of this pack? Okay.
Yeah, I mean, this is the 1 month like implied correlation on the bottom versus the equal weight VIX, and you just see, we're basically down on the bottom left, and usually when you're down towards the bottom left on any of these things, credit spreads at the tights, something like this is the time to start actually looking at vol as a buy, because everybody's on vacation. The squirrel's in his hammock in a 7-degree weather, and like no one's talking about it. But like a lot of what the rally we just saw isn't like anything's changed. I don't think any of these things we've been talking about have changed much at all. It's just that prices are higher, and then narrative changes because prices are higher and everybody's a price follower. But in essence, that's why I was like, oh, let's look at vol. The yen's starting to come back up, which we'll talk about a bit. Like carry trading, vol selling has been the dominant factor here for 2 weeks or so.
Yeah. Okay, let's go back to our old friend here. Your high low beta play, the blue line
Right.
here.
Which is just what we're saying, right? Like the high beta versus low beta dominated until, I don't know, whatever that was, the Fed week peak there. Since then, got dominated until early June, then got dominated, and now it's coming back. Because remember, that's a reverse or inverse thing. Yeah. But it just follows implied correlation, which is what Rupert was talking about with the diffusion trade or the dispersion trade and volatility selling. It's all kind of one thing, and that's kind of why I like to bring these charts up to like kind of square the circle, if you will, of there's people making money just doing the same thing over and over again until they can't anymore.
Okay. I mean, but we've had the move, right? What's the catalyst for a further move, right? That's I mean, I got suckered into starting to buy vol, a few weeks ago, right? And I thought that we were starting to see sort of higher lows in implied correlation and in the vol of vol. Yeah, it's just been smacked straight back down.
It's kind of like fading a growth stock, or it's kind of like, anything. Sometimes like you got to let it run its course till it's kind of extreme, and you can't fade them too early. And I know that from paying the tuition over the years, is that like there's no arbitrage of what the right price is. It's just like you go from a bucket with no leverage to a bucket full of leverage, and you want to take the other side on both sides. Whether it's empty or it's full, you would take the other side. So when we're re-leveraging, you want to be long risk, and we're deleveraging, you want to be short risk. And that's kind of the 101 of how this works.
Okay. Listen, we'll run through the positioning in the vol complex quickly, and then let's talk about FX.
Yeah, I mean, this is actually pretty incredible, huh? Like call option open interest on the S&P divided by put option open interest at the all-time high. And I think that the reason I put this in here was because this is the behavior that then drives some of the charts you saw before. Those charts are results, the outputs of this input buying decision, or behavior, strategy, whatever you want to call
it. Okay. And then the next one here is yeah. Thanks very much for that. Yeah, I don't buy daily straddles, as my readers know, but it's the monthly ones. Well, the 4 to 6 weeks one that I look at have certainly not carried on from where I thought we were seeing the beginnings of a spike. That's for certain.
But what I guess I'd say is that, like, this is kind of a butterfly way of viewing it. What's the cost of all? We're at the year-to-date low. Who knows what's going to happen, right? Like, we know none of us can predict exactly what's going to happen, but like when the price curve that's versus the possibility curve deviates, sometimes there's opportunity. I guess that's the way I would put it.
Okay. And then finally, let's do some FX before we move on to Hong Kong.
Never barks.
Yeah, I got told by I got a text message from Kevin Muir when we did that show with Brent Donnelly about the FX dog that didn't bark. He said, "Yeah, you're just asking for another few more weeks of pain on your FX options, but here you go."
Look at that. I mean, it is kind of interesting, though, because it is like right where it was before 25, and we got that move into Liberation Day, right before COVID, right before 22, right before the GFC, and right before the end of the oil boom, into the Swiss National Bank and all that nonsense.
2015, yeah.
Yeah, so look, I'm not necessarily saying, oh, this is a money maker over the next month or next 2 months or whatever, but if you're inclined to buy a dog that hasn't barked yet but could bark, this is maybe a time to start looking, I guess is what I'm trying to say.
Yeah, I mean, it's timely for me because I have a sort of overlay hedge on my substantially sort of underweight US risk asset beta portfolio, but so Bushy has a strong non-US dollar bias, and one of the big overlays is currently it's a 115 strike euro USD put out to December. Now, as we get into September, that thing's going to start to decay pretty aggressively. So I'm going to be putting together some thoughts in my start the week note, which I need to write after this. But I like the idea of reloading on those puts at this kind of implied. That's for certain.
I want to remind people, like, in the fiscal dominance world, which again I don't know. There's midterms coming up. We have no idea, but politicians like to please people, and we seem to be so financialized that pleasing everyone is the easiest route. And so, I think a credit event's coming, but there is chance that, like, okay, the government then underwrites all the bad credit again, and at some point it plays out in FX vol. And FX vol is correlated pretty highly to equity vol and rates vol. It's just you got to choose your spot, you got to choose your fighter. It's different. It's much more complicated probably than just fix or whatever. But it's worth noting, and it's something that probably most people don't really talk about all that much outside of a small niche of people.
Well, it's a Sunday show, so you obviously want to talk about the yen and the beach ball. Interestingly, the intervention seems a long way away already, right?
It's a beach ball, man. It does what it does. Like, isn't that amazing? Like, look at that peso yen. It's right back to where it was. And remember, peso yen, along with Colombia and a few other countries, Polish zloty, and those are some of the key carry trades. Right back, right? Like, took it on the chin, right back there. And the rest of them, forget about the CNH because it's managed, it's weird. But like euro yen, pop back up, dollar yen, despite what the Squirrel's favorite Treasury Secretary of the world said, where he trolled everyone about buying 10 billion of yen. The carry traders are back in action. They're like, hey, we took it. It's fine. Game's back on. And again, it can't be surprising. This is doing this while vol's selling, while equity risk markets are rising. Again, I just try to connect the dots for people. It's all one fucking trade. Sorry for my French.
Now, finally, let's talk about credit, right? Because
it's interesting because I was listening to a guy talk about insurers and private credit that I have to have a Zoom call with this week. He was on a competing podcast, let's say, and the triple C's minus the double B's still moving out there, while the index is just flat as a board, right? So he was saying that if you look at private credit defaults, they're pretty high. And so I'm just wondering, is underneath the hood, the real economy defaults versus what we publish, what's buyable by the guys who have funds, the mechanics, the mandates, all that stuff, that there could be a credit mirage. And one of the things you want to think about is our friend of the show, Mike Green, who was on a couple weeks ago, talks about passive all the time. But in a world where you have finite elasticity, the buybacks can drive prices up. And if everyone uses that mark-to-market asset prices as a value of the assets, because it's the variable part, well, then it looks like the credit is better than it is. But remember, the credit can't be removed. And so there is something going on here where I think there's a bit of a mirage, and no one cares because everybody who's in the machine taking a toll is in the Hamptons right now, and definitely not talking about markets. Or maybe they're just they're drinking a spritz.
That is an unintended perfect segue, by the way, because in the next segment I want to talk about the ultimate Geo-Macro toll booth, which is Hong Kong, and the convergence of gold, the increasingly international RMB, and the US dollar. And this is the sort of topic of my weekend piece, which was in part inspired by another friend of the show, Louis Gave's piece. And you can hunt this down. This piece is up for free on his website. And I'm just going to read out this quote. For most of its history, Hong Kong was a pipe or a bridge bringing Western capital into China and Chinese goods to the rest of the world. But in this new world, Hong Kong will likely evolve from being a pipe bridge and will instead become a sluice where money no longer just passes through, with Hong Kong lawyers, bankers, and accountants taking a cut, of course, but it actually stays put. The value of Hong Kong is thus that of a toll. It grows with the traffic between the three currencies, gold, the dollar, and the RMB. That is, with mistrust itself. The more the world fragments, the more profitable the crossing points become. And I thought this was an amazing piece, and everyone should read it in full. But it sort of brings me to the worst ever macro trade in my life, which was selling the low in Chinese equities in 2003 and moving back to Europe for 7 years. But at the same time, failing to buy real estate in Hong Kong, right? I got to Hong Kong just after the Asian financial crisis, and
oh god,
yeah, and Hong Kong prices had been absolutely decimated. I mean, if you look at the long term. But just before I go on there, one of the reasons that I was always nervous about owning property in Hong Kong was, well, one, the mortgage system is scary because it's constantly mark to market. It's not like your world where you get a 30-year you get a 30-year mortgage based on a single appraisal. Your loan to value is constantly mark to market in Hong Kong. And if you've got a job that's linked to the stock market, which is highly correlated with the local real estate market, you've got a really good chance of getting a margin call just at the same time as your job is at risk. And the other big deal was that if you ever look at a satellite photograph of Hong Kong, you see just how green it is compared to Shenzhen. And so you really got these very high real estate values where the supply of housing is really, at the end of the day, somewhat artificially scarce. But anyway, in terms of going back to this terrible macro trade, sort of March 2003, sort of dead lows post Asian financial crisis, you know, specifically, I was looking at an apartment in this building at the bottom of the peak on Magazine Gap Road. I got on a plane 2 days after someone else bought an apartment in there, the one that I was looking at, for 14 million Hong Kong, so just under 2 million US, right? By the time I got back to Hong Kong 7 years later, this thing was worth $10 US, the same apartment. The same one again, I mean, so just fast forwarding to 26, probably worth about 17 million US, right? So put 70% leverage on that. That was the worst macro trade, the best macro trade that I never did.
It's funny because we're podcast partners, but like, I moved from Boston to New York in fall of 08, and I had guys offering me incredible deals. And I was like, I'll take the cheaper rent. But like, I look back and I was like, yeah, I shouldn't have been dicking around in the markets. I should have just bought that, had a place on the cheap, like, and then was ruined for real estate because it was like, so it is funny how whatever the event is kind of shapes your thinking quite a bit in markets.
Yeah, absolutely. And so just in my defense, 2003 was also when SARS was going on. So right, living in Hong Kong felt like living on the set of Outbreak, the Wolfgang Peterson movie. It was all getting a little bit hairy. Right. Anyway, as you know, I've been spending a bit of time in Hong Kong this summer, and as you know, I was podcasting from there for over a month. But I tell you what, this town has got its mojo back, and where I think this sort of real asset play on Hong Kong, prime office in central Hong Kong, I think is a really, really interesting multi-decade play from here. I'm not going to go into huge detail on the counters here, but we're finally seeing a tick up in office rents in central, and the vacancy rates are coming down. I think this is the beginning of potentially a really big move. Whatever AI does to the financial services industries, the plush meeting rooms and conference centers and MD's offices of the banking and broking and legal world are still going to be in a pretty concentrated area in a city that I'm increasingly convinced will be Asia's financial capital for a long time to come. When 25 years ago, there used to be this perennial debate about whether Singapore or Hong Kong would win the crown. And one of the reasons that there was a question mark over Hong Kong is that people thought that maybe the CCP would prefer Shanghai's Pudong to be the sort of preeminent financial capital for China. I think that view was possibly wrong then, but it's definitely been superseded now. So I think a bolt hole strategy around this sort of Hong Kong sluice idea of Louis is perfectly expressed through, to my mind, principally prime grade A central office, right? And this stuff looks incredibly attractively priced right now and looks to be inflecting.
I mean, look, you were in Hong Kong a long time. I would say that if you're bullish China, now is probably a decent time. It's been an underperformer, I guess you might say. And
at the index level, but I keep on pointing out there are some people that have been absolutely crushing it. I mean, actively managed Chinese equities have had a pretty good year this year. The reason that optically everyone,
right, like Jeff's doing well because he's good at trading retail stocks. If you're just like, I own the XRT, you're like, dude, I'm down 4 or 5% this year. So skill's getting paid. Let's put it that way.
Skill is definitely getting paid, and there is a macro reason for that. I mean, if you look at the MSCI China, it's dominated by the Barbars, Tencents, and Baidus of this world, and those Chinternet stocks have had just a terrible 9 months right now. But listen, just in the last few minutes, I'm afraid therapy for me. We got to talk about Gavin. As I said, I tried to watch the podcast because it was getting so much coverage. But the idea that us value and macro investors are going to have our brains baked by Anthropic's numbers, based on what we talked about last year with the work we've done on OpenAI and Anthropic valuations, I don't believe it. Right? This idea that you have to be insane not to see the profitability. That this is going to be a voodoo adjusted EBITDA metric, which is going to be preached to us over the next few months. Just be very, very careful. Is my message there.
I would tell you, Squirrel. I was at a buddy's house, hanging around the pool with the guy who was the director and producer out here, but loves the show. And he was telling me some of his buddies, they all thought the EBI-TIT was their favorite new thing. And a few of them work in finance. They all thought that was great. They're like, it's ridiculous. I was like,
EBI-TIT.
We're going to hear a lot more about it. It's going to be the new adjusted EBITDA.
Yeah. Community adjusted EBITDA for foundation labs. Listen, on that front, we had the CoreWeave earnings recently, and just a bonkers move. I thought we'd kind of missed the opportunity, right, to have a go at this. And I'm going to put some ideas together in my start the week note on this. I think both CoreWeave and Labubu Larry are offering up some asymmetric things to do in terms of risk reward on the short side.
Well, they were also in late May and early June when I was put that on, and we were talking about it, and we had a Mish on.
We never got that SPV set up though. That's the problem. You got to move fast on these things.
Around Fed week, it was a bummer because we were like, oh, you never did big enough, blah blah blah, and I knew it kind of had it nailed, and it was like, well, it's just kind of part of markets, sometimes it just moves and it moves too fast, and again, that's why you go back to Gavin. Like, if you're positioned, you're going to do everything you can to get the market to come around to your view, so then you can exit your position and then be like, I don't care anymore because I'm out of there. You know what I mean? Like, that's all I would say. And so CoreWeave's asymmetric. The truth is like the H100, H200s rental index, which is spot, which is not nearly as much volume. They now have a tradable market, which I don't know. I mean, like, Rupert, you were around when they brought in oil futures, and like it financialized.
Sorry. Oil futures have been around for a bit longer, but what you're talking is about when Goldman et al. Created these commodity indices in the early 2000s and financialized.
One is where it really got financialized. Is, I guess, what I'm saying. Yeah, there was some
exactly. Yeah. Well, I just, so in Meb Faber's note, which I just opened up this morning before we got on this, he topped the note with a quote from Simon Mikhailovich, who I'm a big fan of, and he said, "Securitization is like fertilizer. You can grow tomatoes or blow up buildings." And I think that is a really key takeaway to take from Jensen becoming the central bank of AI and creating a securitization product in the form of compute. And no good things happen from that.
In my capital misallocation chat, a guy who's a client of both of ours brought up, who's a former capital markets banker himself, that Jensen quietly talked down the amount of the financing by 50% on a Friday afternoon. And we know about Friday afternoons, don't we?
Friday afternoons in August is a good day to bury bad news. It's a really good day to bury bad news.
Maybe the best.
Yeah, absolutely. All right, guys. Good luck out there this week. Don't go to sleep. Things happen when you're feeling the sleepiest. We will leave it there. Benny and the Squirrel on the sleepy dog days of August, and we're out.